Hi, thanks for clicking in today. I wanted to talk a little bit uh, in regard to the tragic disaster in California, the insurance market in California, why it is so difficult. The people who couldn't get insurance can't get insurance, and going forward, and also the issues that made and make that insurance market so difficult. And one place to start might be to look at what insurance companies, the way that they think about these things. And to start, they look at a basic financial ratio. It's a big P&L, loss ratio or combined ratio. And really, you just take the gross premiums written, you compare that to the claims outlay and operational expense outlay. And that you want one of those numbers to be a lot bigger than the other numbers. So, for example, you may make it understandable, $1 million in gross written premium, and you have $800,000 that will go out in claims and related expenses. So that's an 80% loss ratio. That's a pretty good business because you're taking that 200 grand. And let's remember that 200 grand when you're an insurance company is a lot bigger number, but you're taking that 20% and you're putting that to work as investment. So, that's a business that works. Can an insurance company make money at 90, 95, maybe even higher loss ratio? Yeah, they can. But then the investment capital has to work a lot harder. Can they make money at a 500, at 1,000? They can survive. You need a lot more, 80% years. And that's when you get into loss reserves and reinsurance. But that's the nature of the business. There are times when catastrophic losses will take place. What is very difficult for an insurance company to be able to manage is continuous 115% loss ratios, where you're looking at this and you're saying, geez, I got to get more rate, which is underwriter lingo for increased prices. I got to get rate, or I got to reduce my exposure basis, meaning essentially non-renewing or canceling insurance policies in order to reduce the payout. You either need more revenue or you reduce the expense going out. So in California, it is very difficult to raise rates. Insurance is a highly regulated business. And regulation is good and constructive. It is attractive to legislators to regulate, and the public seeks regulation because of the universality of insurance. Everybody buys this stuff. It affects everybody, and everybody wants to, lower their costs. So you have regulation at times which can have well-intended objectives, but really poor unintended outcomes to that legislation. And in California, we had something take place called Proposition 103. This was a long time ago. It was in 1988, but it was significant in affecting the market. Among the things that it did was and this was looked at as like a consumer protection. There were consumer advocates stating that this would be something that would reduce costs. And what it did was it made any increase that a homeowner's carrier was going to be able to obtain subject to a public hearing and subject to the approval of the insurance commissioner. And the insurance commissioner is an elected position. So you have then an elected official saying, hey, I'm the guy who raised everybody's insurance premiums, and that is no bumper sticker for electoral victory in your next race. So carriers would go and say, look, we have our costs are up. We need to raise prices by 17%, and maybe they get a 2% increase. And so, you do that dance for what's been going on as a long time. And due to that, insurers would shrink their footprint. If you can't get the revenue up, then you got to get the cost down. So they shrink their footprint through non-renewal and cancellation of policies and other things. But those are the big things. And then what that creates is scarcity in the market. It creates higher pricing charged by the remaining players, and it creates, you know, difficulty in obtaining the product and in obtaining the homeowner's policy. So in California, as in many states, there is a facility of last resort for the people who are unable, because the withdrawing in California, you may have heard State Farm had withdrawn from that market. Over the past few years, it's of the 12 largest players in the California homeowners market, seven of them left, withdrew from that market in one form or another. So that means that a lot of people are going to the FAIR plan. And the FAIR plan in California is not an insurance company. And therefore, it is not subject to the strength tests, the regulation. AM Best is not looking at the FAIR plan. It is basically a government agency, and it's funded by a state which has its own financial problems. So we have a lot of people who are in the FAIR plan in California. And let me just interject and say that, there are people saying, oh, are these people going to get paid? These poor people in California with these wildfires. Yeah, if they had an insurance policy, I mean, I don't expect anybody to have a problem getting paid. These are not complex claims. This is the perilous fire. These policies all provide coverage for fire. It's not like, oh, geez, I wonder what happened. I wonder what caused this. No, the house burned down. Here's the check. It should all work like that. Although these people paid too much for that, and even those people in the FAIR plan. Now, that also assumes that the carrier has money, and I expect the private carriers will meet their obligations. They're in that business. The FAIR plan, though, I'm not sure. The FAIR plan, and I haven't looked at the financials of the FAIR plan, but I've read in the industry news that the FAIR plan basically has $500 million in reserve and reinsurance of $2.5 billion. These are not big numbers, for an insurance company. The exposure that it is estimated that the FAIR plan has with these California fires is $25 billion. So that's a lot of billions of dollars that there are not checks getting written for. That's a problem. To talk this through, what happens next is that the rules in California are that should the FAIR plan not meet its obligations to these policyholders, there will be an allocation made against all of the carriers who are writing business in California. And that's not just carriers writing homeowners policy. That could be carriers, specialty wine program for wineries in Northern California. They are all based on the percentage of business they write in California going to get the bill for the failure of the FAIR plan. So that, the unintended consequence there is that you're affecting in a negative way the entire insurance market. And I know, we see this here just as an agency in New Jersey. We have business in California. Over the past 12 months, we've had some very difficult placements there. Accounts at an apartment building, an office, which should be desirable from an underwriting standpoint, assumed to be profitable business when you put it on the books, and we can't get terms. And that's because there's a lot of players who have exited that California market because they don't want to pick up that FAIR plan tab. So that's the kind of the overview on the market. And regulation isn't the only problem in California. There are other problems. You hear about that chaparral and that that wood that burns really ignites easily. So there's a lot of factors there, but improving the regulatory environment would certainly help. And, this has been done before. It reminds me of New Jersey 25, I guess, years ago, where we had a horrific personal auto market. State legislators came in and, created regulation in order to make things inexpensive or less expensive. And it had the opposite effect of carriers leaving, creating scarcity and driving up demand and costs. So the state then formed something which was the California FAIR plan, essentially for New Jersey personal law. It's called the JUA, the Joint Underwriting Authority, which wound up with half the market in New Jersey and people paying more than they ever had. So there's something very interesting that happened, and it might be a subject of another video, but there's something that then compelled those legislators to address that, to get their sharpen their pencils and address that matter and roll back some of what had been done to the point where it became a competitive market. Today it's been competitive for decades. I know it's still expensive, but can my office give you 7, 8, 10 Liberty Mutual, Travelers, all these personal auto quotes? Yeah, we can. Those carriers exist in a competitive market where they can make money by best serving and being the best option for their customers. So hopefully that will happen in California, and hopefully that will happen really soon. So that's it. That's my overview. I appreciate your attention and attention span to this insurance communication. And thank you very much. Goodbye.